Hello everyone, I'm Marty Pospisil, and I have a very special guest with us today, Paula Siemens from
Invis the Siemens Group.
Invis the Siemens Group, and she is going to discuss with us today the question that I'm being asked a lot, and I thought, why not bring in an expert to chat with us about this? What's happening with interest rates? Why are they high? What are the factors? And when can I, as a consumer, expect the rates to come back down? Whoa, that's a loaded question.
It is.
It's the billion-dollar question,
It's the
trillion-dollar
question, exactly.
Yeah, of what's happening. So maybe, Paula, let's start with why are the rates high today? What are the factors that have caused this rapid 6-month historical increase of rates?
Well, really, to be honest, it's kind of started with COVID.
Okay.
Because during COVID, obviously there were a lot of government incentive programs, and there was a lot of money put into the system. The rates were cut to try to spur economic activity during the lockdowns and that type of thing. So that was the beginning. And essentially the Bank of Canada cut probably too much too long is the best.
And maybe spent too much as well.
And spent a lot.
Right. 800 billion is the figure I've heard.
Yeah,
Wow.
I'm not sure what that figure is, but I know it's an awful lot. And then, so that's inflationary in itself. But then in February, when Russia invaded Ukraine, that really exasperated everything with supply chain issues, with oil and gas going up. And so that really sort of put the oil on the fire, so to speak.
Right.
And now we're in a situation where the Bank of Canada realized, okay, we probably should have started to increase the rates sooner, and we didn't, and inflation is out of control. So now the Bank of Canada has to throw everything they have at it to try to get inflation down to the 2%. Even 3% I think they'd be happy with right now.
Right.
And it's not happening because we're all spending money, because we had pent up demand to travel or to buy things, because
go out for dinner, buy the big screen TV,
everything,
all of that.
Everything.
Right.
And then of course with housing, as you know, we had tremendous amount of activity in 2020, 2021, where people were no longer working in the office and they were able to change their living situation. And so what that did is, it just sort of pushed forward a lot of activity that maybe would have happened over a period of 5 years or so into like 1 and 2 years.
Right.
So all of those things combined, basically there's just too much inflation, and the bond market effectively started to go up first by basically saying, indicating that they felt that the rates were too low and that they needed to increase. So the bond market's always ahead of.
This is where I get lost on the interest. So thank you for bringing this up. I understand inflation, the government needing to bring it down, because it's not a good thing to have for a long time, because it can start to become accepted by the consumer, and it's not a good thing.
Well, the real concern is that with inflation, the problem is that it puts pressure on wages.
Right.
And so when you have to start paying everybody more because the cost of living is so high,
right?
That gets baked in. It's not like you can say, here's your raise, and then, oh no, I'm going to take it back.
Because inflation's down, we're going to bring your salary down.
So what happens is,
Doesn't work.
as soon as you start to see wage inflation, it gets baked in, as they say, because it's not going away. You don't go backwards. So now with wage inflation, that causes everything to cost more. And that's inflationary in itself. So
and it jumps again, and then the wages have to catch up. It gets out of control.
Yeah, so that's the cycle that the Bank of Canada is trying to stop. At the same time, the bond market is what impacts the fixed rates, and the bond market is forward thinking. They're always looking at, is my bond going to be worth anything, in the next few days, months, years, what have you. And if they feel that rates are going to go up or inflation's going to go up, the bond market, the yields end up having to go up, and then the mortgage rates end up going up. So
okay.
that's sort of what's happening. We've got two markets, the Bank of Canada doing what they're doing, and the bond market doing what they're doing.
Which is independent.
Yes.
And who's buying the bonds?
Well, generally speaking, it's big corporations or what have you. For a period of time, the Bank of Canada was buying the bonds.
Right. And in fact, they're losing money on the bonds they bought now.
Correct.
Right.
Yeah.
Interesting.
So they were buying the bonds, trying to keep the mortgage rates low.
Right.
During COVID. And then, so one of the first things that the Bank of Canada does when they're trying to stave off inflation is that they will sell those bonds. And even though they're selling them at a loss, they will sell it. So there needs to be more buyers for those bonds that are being sold by the Bank of Canada. Well, you have to offer those buyers a better rate of return, so the rates go up. And so that's sort of what's been happening with regards to the last, since March 2022. We've started to, in September actually, 2021, the bond market was reacting first. The Bank of Canada hadn't reacted yet, but the bond market started to tell us that they didn't like where rates were. And consistently we've had increases in the fixed rates ever since September 2021.
Right. And interestingly enough, once the Bank of Canada started to react, we hit that peak in March, April of our market. And as soon as the lending rates increased, we started to lose buyers.
Right.
It was almost immediate. It's such an important factor in our market is the lending rates.
Yeah. And there's a lot of people, there's a certain age group that have never seen normal rates.
Oh my God.
So
1980, 81.
Yeah.
Nelson Scalbania days.
Yeah.
I remember interest
goodness.
rates 20%.
Yes.
Could you imagine?
Yeah.
I think everyone would be handing their keys in to the bank today.
For sure. Well,
20%.
Because the mortgage size is so much bigger than it was back then.
It's not serviceable.
Yeah. Yeah.
So I don't know if we'll ever see that again, but I do
Fingers
remember.
crossed.
But the mortgages were much smaller in 80 and 81.
Oh, absolutely.
Right.
Yeah.
So it's a whole different era.
Yeah.
But I can understand their target inflation is between 2% and 3%.
Yes.
Right.
So the Bank of Canada really wants to try to get it to 2%. I don't know if we're going to hit that or if we'll be happy at 3%. But the forecast is that we should reach that level by sometime in 2024. It's now looking sort of the latter part of 2024. And then at that point, we should start to see eventually the Bank of Canada cutting the overnight rate. But it probably will be quite slow because they really want to make sure that they don't go backwards.
Right. Too quickly, too soon.
Yeah. So
Paula, that's 2 years of potentially high rates. That's a long time. And the reason I'm asking this, obviously, on behalf of our clients, is people are asking me, look, Marty, when are prices going to come back? Well, prices will come back when the market heats up and buyers can borrow at a more reasonable mortgage rate, which is directly connected to inflation and the Bank of Canada dropping their rates. So they're all connected. And we're probably not going to see the bottoming out of our market until you start to see some consumer confidence that inflation is now under control and starting to come back. Is that a fair statement?
Yeah, and the Bank of Canada will end up increasing December 7th, and then they probably will do 1 or 2 increases at the beginning part of 2023. And then the belief is that they will be done.
Okay.
And then it will be a flat Bank of Canada rate for the rest of 2023. And then at some point in 2024, there will be some level of cutting.
Okay, because there's a lag time from when they make an increase to the impact in the market.
Yeah, that's what's so surprising about how the Bank of Canada has raised the rates so quickly.
Right.
The increments of the increases, the 1% increase that we had in July
Incredible.
was incredible.
Yeah.
Because it typically takes 3 to 6 months for every increase or decrease to kind of filter into the economy. And so
Fair enough.
I think that the belief is that the Bank of Canada has overshot this. There's no doubt, but everybody also understands why the Bank of Canada has done what they've done, because they have to get the inflation in check.
Under control.
Under
Absolutely.
control,
It's critical. That's really interesting. So that's a fair amount of time, which could change.
Yeah, could
What
change.
would have to change besides the war ending and people's,
War ending would be a good one.
that would be a good start, right? That
be a
would bring
great
energy
start.
costs back down.
Yeah.
Give a little bit of a breathing room for the economy, and people would feel a lot better. Particularly those living in Europe. Horrific. But that would be one thing that could change. What else would have to happen for that inflation figure to start dropping?
I joke with clients and just say, just stop spending money. If everybody
Fair enough.
just stopped spending money on things that they don't absolutely have to have,
I'm in.
that would bring the inflation down so much faster.
I'm in.
So I just say, if you want better rates, just stop spending money.
Here's an idea. Don't buy gifts for everyone at Christmas.
Yeah.
Do a gift draw. That's what we're doing with
yeah,
our
that's a good
family, right?
idea.
One gift and put a limit on it, whatever that is.
Yeah.
That's reasonable. And do a gift draw in your family, so you're not buying 12 gifts. You're buying one nice gift.
Yeah.
Right.
Yeah, that's a great idea.
There's my input
There you go.
for you guys.
It's a good one.
But yeah, we all have to start spending less. War could end. Oh, wouldn't that be great? Any other things that the supply chain issues maybe get worked through a little better?
Yeah, the supply chain issues. I mean, unfortunately, we're still seeing it in China. That's the unfortunate thing. I have a client that's in transportation, and he says that a lot of the supply chain issue isn't a real problem anymore. There's shipping containers going out, with less stuff.
Right.
But in some places, there's obviously issues still, like obviously in the chip manufacturing,
Right.
and certain metal restrictions or lack of inventory. Those are obviously still impacting our supply chain.
And surprisingly, how much of the raw materials were actually coming from the Ukraine? That's something
that
I
is
wasn't
surprising.
aware.
No, I didn't know that either.
Which is incredible, how this one small area of the world, of course, going through this horrific war, is impacting everyone in the world because of.
Well, it just goes to show how interconnected we are.
We are very interconnected.
and that's why harmony is really important, people.
Let's get along. Let's
get
work
along.
this out. Yeah.
Anyways, but
without getting political.
Yeah, without getting political.
So, wow, it could be as much as 2 years before we start to see that happen.
Yes, and
Right.
then we're expecting that we'll probably see a 1% decrease in the fixed rates.
Right.
So instead of being in the mid 5s, we'll be in the mid 4s.
Right.
And then
For a
maybe
while.
we would get to low 4s, maybe we would get to high 3s, but that's going to be the new normal. Like that's
Right.
where we were going before all of this started.
Of course.
So
Yeah.
prior to COVID, we were going into an increasing rate market. And we were
Already.
Yeah, we were striving to, or
Fair
the
enough.
industry was striving to get into the 4s and 5s, which used to be our normal.
Right. So we're not going to see that
We're
1.88%
not
mortgage
seeing
for a
that.
long time.
No,
Right.
I can't see that happening
Right.
for a very long time.
Those were incredible rates
Yes,
that we saw.
I know.
Incredible. I thought it's almost free money.
I know it's
Really?
very,
Right?
very.
So that's really interesting. And what I'm hearing is we're not expecting a dramatic short term for these decreases. They're going to very carefully step downwards over a longer period of time. It's not going to be in 6 months.
No, I don't think it's
No.
going to be in 6 months.
Okay.
It could be the 1% from the Bank of Canada could come in a matter of like within the year for sure. It's just a matter of what the bond market sees in the future. So
within the year of 2023 or 2024?
2024 for the Bank of Canada.
Right, okay.
We're already seeing bond yields fall right now. And so we are seeing on the insured mortgage side rates coming down a little bit. So we do have like a 5-year right now at 5.05 with one lender. But then on the uninsured side, we're looking at closer to 5.6. So the spread between insured money and uninsured money is quite big right now.
Interesting. Why is that? Why is there a spread?
Because insured money, what that means to the lender itself is that they can sell that mortgage into the Canada mortgage bond and get their money back. And so they can re-lend that money over and over and over. So it becomes the most efficient, cheapest form of lending that any lender can do.
And when we say insured, is that a higher ratio mortgage?
So it means that you have less than 20% down and that your price is under $1 million, and that your mortgage has to be on 25-year amortization. So the consumer pays the insurance premium for the option to have less than 20% down, and then that mortgage is allowed to be sold into the Canada mortgage bond.
But they're getting a better rate.
Yes,
right. So that's really interesting.
Rate. Yeah,
okay.
So a first-time home buyer will get a lower rate than everybody else.
You'd think it would be the opposite. I'm putting more cash in. I've got more than 25 or 20% down. I should be getting a much better rate, but not the case. So that's really interesting.
And you would think that I've had 4 mortgages, and I have a long-standing employment credit situation, and people are surprised that they don't get those rates.
Right. Yeah, for sure. So very interesting.
Very interesting.
Yeah, how that works. Okay, well, that's a really good discussion. It looks like it's going to be a bit of time, you guys, before we see the rates dropping again. Even if everything goes perfectly, we have a lot of good news taking place, this is going to take some time to filter through in the Bank of Canada starting to drop their rates. So it'll be good to maybe do an update every so often with you guys, and hopefully, Paula, you can help us out with that.
Yeah, for sure.
And keep you guys informed with what's happening with the rates. I know you're reading a lot of articles, a lot of media on this, but it's always good to have this sort of fireside chat. Maybe I should have a fire going in the background.
That would be a great
Wouldn't
idea.
that be nice? Fireside chat? That's a great idea.
Especially during fall, winter.
Exactly, of course. Thank you, Paula.
You're
very,
welcome.
very informative. And I hope you all enjoyed that. Thank you very much for joining us.